welcome again. Today, this video is regarding IAS 21 and IAS 21, which is your effect of changes in foreign exchange. So what basically we are going to see, as you can see on your screen, is that foreign currency transaction. This is the crux point which we are going to discuss in this particular video. So now what is the crux point? So in a foreign currency transaction, as you can see, there are as we all Indians requires two types of recognition. The first one is initial recognition and the second one is subsequent recognition. The initial recognition always should be at transaction price. Now what is transaction price? As you can see, initial recognition, spot rate on date of transaction. So we should record the particular transaction in we should record the particular transaction on spot rate as on the date transaction took place. When the transaction took place, as on that date, what is the spot rate? And on that spot rate, we will record our the transaction in our books of accounts. Now subsequent measurement is basically each at reporting date only. Subsequent measurement or subsequent reporting at reporting date. So what is reporting date? Reporting date is basically just your balance sheet date. Your balance sheet date, that is your year ending date or whatever it is. Okay. So subsequent measurement have three things, as you can see down the line. Three things. First one is monetary item. Second one is non-monetary item recorded at historical cost, and in that non-monetary item, second thing is non-monetary item at fair value. So now what is the recognition for this particular thing? Yeah, so I was talking about a recognition thing. Recognition, as we have discussed, monetary, non-monetary. Monetary item should be subsequently measured at each reporting date on closing rate. Monetary item closing rate. Non-monetary item historical cost, no translation. Now why no translation? Just it is simply because we need that non-monetary item to be at historical cost only. So we will keep that on historical cost. So the cost which will record that non-monetary item on spot rate at as on transaction date. So and non-monetary item at fair value. Non-monetary item at fair value simply when the fair value took place. Okay. So now as you can see, I have changed the pages. Now I am going to elaborate one example which you can see there. So in which we have property, plant and equipment, receivables, issued capital, opening retained earnings, profit for the year, account payable, accrued liabilities. Okay, so what the question says required is translate the statement of financial position of Infotech Global Limited into $, ready for consolidation by Infotech Limited. Prepare a working for cumulative balance on foreign currency translation reserve. So rates are given below. Opening rate 1.22, average rate 1.175, and closing rate 1.13. So now we are quickly applying the concept which we have learned before to this particular sum. So now monetary item should be recorded at each spot rate on transaction date. So we have assumed that so first of all we will bifurcate what are the monetary items and what are for what items we require translation and for what we does not require the translation. So first, your property, plant and equipment, yes, it is a monetary item, we require a translation. Then second is your receivables, we require translation. Issued capital, opening retained earnings, they have already given your balances on foreign currency, functional currency. Profit for the year, yes, we require that. Account payable, yes, we require that. Accrued liabilities, yes, again we require that. So now what we are going to see is that what rate we should apply. So on this basis we will see one thing. Wait. Yeah, I hope you can see this. Yes. So on property, plant and equipment, this particular thing we are using the, as this is a non-monetary, as this is a monetary item, we require this to be translated at closing rate. So rate on closing date is your 1.13. So this is 1.13. This is again a monetary item. So on 1.13 we have translated. Issued capital we have taken on this amount. Opening retained earnings on this amount. Profit for the year. So now profit for the year. Can you comment below down what rate we can use for the profit for the year? If yes, I hope you have correctly guessed what rate we can use. So we can use average rate, that is your 1.175. In case you are not getting why we have used 1.175, then I will tell you one simple reason, that profit, we have earned the profit during the year, not on the starting and not on the end of the year. So we have used the average rate. Again, these two things are monetary items, so we are using the closing rate. By translating, we can come up with, if you translate the things, one thing, will you multiply or divide these things? So for that purpose, what they have said is $1 is equal to USD 1.22. So we have USD, and 1.13, 1 LSD. So we have this. So 50,000 USD is here and 1 LSD. So we will divide the thing. So 50,000 divided by 1.13. So this will be your answer. As you can see here, solution is given, but you just do your translation and comment below the answer. I will respond to it whether the answer is correct. What you require: translate the statement of financial position into this, ready for consolidation or infotech. You have to show the foreign currency transaction. You have to basically show these things. Translation reserve. You have to calculate the translation reserve and comment below. What you need to do is translation reserve. You have to calculate the translation reserve and comment below.